Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Mike Larson. He is the Senior Analyst at Weiss Ratings. He writes two newsletters. One's called Safe Money Report, and the other one's called Under the Radar Stocks. Welcome to the Money Answer Show, Mike.
Glad to be here.
Just tell us a little bit about your experience leading into your time at Weiss Ratings.
Sure. My background, I came into the business working at Bloomberg News in Boston and following the markets there. And then I started with a company called Bankrate.com, the old Bankrate Monitor, in the early 2000s. And that's sort of where I picked up, or late 90s, early 2000s, where I picked up my particular interest in the rate markets and sort of what interest rates mean for the stock market and the economy overall. So that's my background in researching that part of the market. And then I joined Weiss back in 2001 and have been associated with a number of different products and services that we've offered. But again, sort of carried forward that area, that focus on interest rates and what they mean for investors and sort of how it impacts the outlook for other investments in the stock and currency and commodity markets as well. So that's where I come at this from. I love the business. I think there's always something new and exciting to follow and new trends every day to catch up on. So I think it's been a real rewarding experience over the years.
So tell us a little bit about Safe Money Report. Who is it aimed at, and what kind of investments are you looking for investors in Safe Money Report?
Sure. The Safe Money Report is our company's flagship newsletter. We've been publishing it in one form or another since the late 1970s. Dr. Martin Weiss is the founder of the company, and I still work with him these days talking about investment strategy and so on. In the Safe Money Report, as you might guess from the name, we're generally more conservative. We're looking to tend to recommend investments that offer dividend protection, that give you a margin of safety, that aren't just sort of chasing the latest fads, but are based on a methodology, a multi-step methodology that we use that kind of identifies higher yielding companies that do offer sustainable and growing dividends, that have the ability to pay those dividends in good and bad environments. And also, we do look into other asset classes as well when we think it's appropriate. We will have things like ETFs, also gold allocations and so on, when I believe that need for safety and soundness exists outside of just the stock market. And again, we're pretty happy with how things have been going lately. I mean, this has been a market the last couple of years, really since the beginning of 2018, that has rewarded safe money investing. Those types of companies have actually outperformed. An emphasis in this late cycle environment on more safe defensive investing has really paid off for people.
Now you have something called the Weiss Rating system, and you rate individual stocks. Just briefly explain how the Weiss Rating system works and how you use that in recommending stocks.
Sure. Our company we still do publish two types of ratings. We publish investment ratings, and we publish safety ratings. We actually originally got into the safety ratings business where the theory, developing a model that's designed to basically look at the safety and soundness of banks, insurance companies, credit unions, and so on, from a perspective of is this bank or other institution at risk of failure or not. Therefore, should you be confident or less confident in dealing with them in terms of shopping for life insurance or depositing your money there in the bank and so on. So we have that on the safety rating side. And then on the investment rating side, we do evaluate every stock that's traded in the U.S. or Canadian markets. We do also evaluate ETFs and mutual funds. So all told, in terms of data, it's somewhere on the order of about 40,000 different asset classes, individual or institutions, and so on when it comes to publishing ratings. So it is a quantitative system that looks at a number of different factors, and that's kind of a starting point. We publish ratings anywhere from an A or B, which equates to a buy, to C's, which essentially is in Wall Street term is sell, is hold, and D's and E's would be sells. And people can use that as kind of a guideline. They can look at their stocks, their ETFs, their mutual funds, see how they're rated, and it sort of acts as a good either it supports your view, your bullish view on a particular stock, or it refutes it and kind of tells you maybe you need to do a little bit more research here with the individual investments you've picked.
And over time, have the A's and B's outperformed the D's and E's?
Yes, we've studied the results and done a lot of back testing on the model, and we've had the stock ratings model operating since the 1990s. So this is something that's been sort of tested over a long time scale. But yes, we find that over time the A's outperform the B's, which outperform the C's, and so on. And I think it can be a useful guide, and at least whether it's a starting point for research. I use a lot of screening in my own services where I'll look at a general rating screen to see, okay, get rid of the hold and sell names. Let's just look at buys, and then within that universe, if I feel utilities are a solid pick, or if for some reason I'm bullish on the banks at a point in time, I can use that initial rating screen to get rid of the names that I think are, the system itself is finding as less fundamentally and technically sound, and then go from there and conduct my own research beyond that.
Very good. So let's take a look at a broad view of the world economy now. I mean, the general consensus would be, before the coronavirus came along, that we're growing in the United States, maybe growing slower in Europe and Japan and Asia, but still basically growing. We've got these trade deals. Brexit is now confirmed. Interest rates are low, if not negative. So everything's pretty well going along well. The stock market's been in a bull market for 11 years or so. So what could go wrong? That's kind of the basic impression. What is your view of that?
Sure. There's a few things that I think I would maybe take the other side of there, and I would back things up a little bit to the first quarter of 2018, and that's when we really started to see a change in the pattern. While the market overall did manage, in terms of the S&P 500, did manage to make marginal new highs a couple of times after that point, at each point that it made a new high, we saw less participation in our own rating screens. In other words, if you look at the ratio of buys to sells in the Weiss rating system, we were making lower highs in that ratio, even as the S&P was making slightly higher highs. And that fits with basically a message of less participation in the market. You can see it if you look at things like small caps, if you look at things like transport stocks or financials. There's other sectors that have been lagging the market and have been since that first quarter of 2018. Before that point in time, it was a market that had very broad participation. The secondary indicators were confirming new highs. But again, things have changed since then. I think it's for an important reason, and that's that we've kind of reached the tail end of this economic and credit cycle. We've seen a lot of easy lending. We've seen a lot of extreme behavior, particularly on the corporate debt and corporate borrowing side, somewhat akin to what we saw on the mortgage and consumer side in the last cycle. And I think we've seen sort of running out of steam since then. If you look at sector performance, what's been outperforming and what's been underperforming, up to that point, it was a lot of the more offensive early and mid-cycle type sectors, your transports, your financials, your growthier type stuff. Since that point in time, it's really been your more defensive, pre-recession, safety-oriented sectors that have outperformed. So things like utilities, REITs, consumer staples, and so on. I mean, the numbers obviously change all the time, but if you look at the 2-year performance, utilities on average are up about 50%, 51% in total return. So that's a large advantage or a large beat in performance relative to not just the S&P, but sectors like financials and transports, which are up maybe 10% or less during that time frame. So again, it's a different kind of environment, and it really has been changing since the first quarter of 2018. And that means investors have to adopt different strategies or really look to do some rotation to try and make the most out of this environment that we're in now versus that confirmed, very broad, unadulterated bull trend that we had from 2009 up to that point.
But how about technology stocks? You have Apple and Facebook and Google and Amazon. All those companies have done extremely well, gone to new highs. That's an anomaly to what you're saying.
Yeah, that is pretty much the only other sector that has not fit the bill, if you will, that in sort of the defensive. So you are right that, especially in the mega cap arena, the very large tech stocks, the FANG names, whatever term you want to use, they have been sort of the one exception to that. But one thing that I've seen, in the case of the select handful of very cash-rich, large technology stocks, is essentially they're not in as bad shape or bubble-licious territory or whatever you want to call it as they were in the dot-com cycle. It's a different kind of tech company when you look at things like Apple and Microsoft and so on. But I think outside of that handful of names, really, if you look at these other sectors, that's where the outperformance has been, and that's what investors have been flocking to. And I think it's a very obvious reason for that. We're in this low-rate, low-yield environment where people want, with a 10-year Treasury yield falling, with this ZIRP, NERP world, zero or negative or very low interest rate policy around the world, it's tough to generate income. You can't get it from government bonds the way you used to be able to. So I think investors are desperately seeking that income, that yield, and that's what you're finding, or that's why you're seeing these higher-yielding, more defensive sectors outperform. That's where the yield, even relative to history, the yields are low, but at least it's beating what you're going to get in the S&P. It's beating what you're going to get 10-year Treasury, and so on.
Well, some would say that, talk about bubblicious, that all the bonds and bond proxies like REITs and utilities are extreme overvaluation because of this kind of search for yield. Do you think that's true, or do you think they have further to go?
Oh, I think they're definitely extended, no doubt. I mean, when I look at what I did in the Safe Money Report portfolio and sort of spotting this trend, I mean, we rotated out of the aggressive things and into these more defensive sectors 2+ years ago. So it's been a very nice environment and very profitable trade and investment shift to make for 2 years. That said, at some point, this trend is going to end. I just don't yet think we're at that point, because I still think heading into a weakening economy, which is kind of my base case scenario, where recession risk is elevated even before the coronavirus news, all of those factors tend to argue for rates staying low. And I wouldn't be surprised if the Fed ultimately has to cut 2 or 3 times this year beyond what they did last year to try and support the economy. And in that environment, I think that the dividend-paying type names and ETFs that make money in a low-rate environment, those types of investments are still going to do very well for you.
Very good. We're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Mike Larson. He's the Senior Analyst at Weiss Ratings. He's the editor of the Safe Money Report and also the Under the Radar Stocks newsletter. You can find out more about him at his website, which is weissratings.com. We'll be back after this. You may not be the greatest at getting places early, especially when traveling and getting to the airport early enough to avoid that I might miss my flight anxiety. That's why I'm excited about Clear. Using Clear reduces your stress big time because you bypass those long security check-in lines. So you never have to run to your gate again. Clear helps you zip through airport security with a tap of your fingers so you can get to your gate faster and relax. Clear replaces the need for physical ID cards because the system recognizes your eyes and fingerprints to get you through security quickly. With Clear, you are the best ID. Enrolling is quick and easy. Get started online, then finish enrolling at the airport with the help of a friendly Clear ambassador. No need to make an appointment. It takes just about 5 minutes. Then you can immediately use Clear. Clear also helps you get through security faster at stadiums and other locations around the country. Clear members can add up to 3 family members for the discounted rate of only $50 a year. Kids under 18 are free when tagging along with a Clear member. I remember vividly when I was taking a flight out of Las Vegas, and the line of security would have taken at least an hour to get through, but I breezed right to the gate using Clear. Another time, I was coming home from Orlando, and I zoomed right past hundreds of screaming kids in all their Disney costumes to get right on my flight in plenty of time. Clear is absolutely the best way to get through airport security. It works great with TSA PreCheck, too. Right now, listeners to the Money Answer Show can get their first 2 months of Clear for free. Go to clearme.com/moneyanswers and use code moneyanswers. That's clearme.com/moneyanswers and use code moneyanswers for your free 2 months of Clear.
We're always talking business. Talk to an expert. Call now toll free 866-472-5790. That's 866-472-5790. Voice America Business Network.
Many industries have been revolutionized by technology in the last decade. Books, music, TV, communications, and now it's happening to our money and the way we pay. Tune in to Breaking Banks with Brett King for a look at how technology and customer behavior will bring about more changes in banking in the next 10 years than in the last 200 years. Listen every Thursday at 3 p.m. Eastern Time, noon Pacific on Voice America Business Channel or on AM 1160 The Voice. You'll never look at your bank account the same again.
Your leadership journey must be a continuous process of education and improvement. If you think you've learned all you need to know, think again. Find out the latest from contemporary authors on topics from character to values and everything in between. Discover insights into servant leader fundamentals, along with your host, Tom Crea. Tune into Your Evolving Leadership Journey, Mondays at 9 a.m. Eastern Time and 6 a.m. Pacific Time on the Voice America Business Channel.
Are you finding your frequency? It can be described as that space between failure and success. It's the future of digital media. It's finding your voice. It's engaging topics, content, and ideas. Jeff and Ryan discuss the digital media space and all of its aspects. It's about making the mistakes, taking the chances, summoning the intestinal fortitude to step out of your comfort zone, and discovering what you can accomplish when you decide to try, decide to learn, decide that you have something to say, and find your frequency. Live Fridays at 12 noon Pacific Time, 3 p.m. Eastern Time on the Voice America Variety Channel.
We're always talking business. Talk to an expert. Call now, toll free, 866-472-5790. That's 866-472-5790. Voice America Business Network.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Mike Larson, Senior Analyst at Weiss Ratings, editor of the Safe Money Report and the Under the Radar Stocks newsletter. You can find out more at his website, weissratings.com. Welcome back to the show, Mike.
Hey, glad to be here.
So we're talking about the economy slowing down, and obviously the thing that's hitting everybody right now is this coronavirus. What is your expectation of what's going to happen, and what is the economic impact going to be worldwide?
Sure, I see two things going on here. First of all, in the very short term, last few weeks, obviously the coronavirus is the big story. Many companies now have a lot of exposure to China in terms of customers over there or supply chains that rely on Chinese manufacturing and so on. So I think it's going to be a clear disruptor and something that's going to be with us for a while in terms of impact on bottom lines for companies. I mean, especially in sectors like technology or in some of the retail sectors where companies were counting on Chinese sales to really sort of boost their overall results. So that's going to be an issue from an earnings standpoint going forward. But I think what's important for people to understand, too, is that this is amplifying some trends that were already in place, but those trends were, in fact, already in place. The economy, in my opinion, and based on a lot of the data that I've seen, has been slowing for some time now. We're starting to see the trend in jobless claims flatten out. It stopped improving. It's not getting worse. It's not recessionary yet, but we've seen improvement stop there. We've seen certain sectors like autos really lose some steam in terms of sales. Sales have been declining for the last couple of years in the auto sector, gradually, nothing too steep, but it is out there. You have business spending that's been weak for almost a full year now, and obviously manufacturing, even before the coronavirus news, was weak and was having issues related to trade and tariffs and so on with China as well. So you throw it all in the pot together, and you can see, for example, interest rates, they didn't just start falling recently as a result of the coronavirus news. They've been falling since the fall of 2018. We've seen the yield curve flattening for more than 18 months up until last year where it actually started to invert in the spring. Those are typical things you see at the end of an economic cycle. So I think the markets sort of behind the scenes have been pricing in economic weakness or a coming downturn in the economy, or slowdown, I should say, if not a full-blown recession. So I think that trend was already there. Coronavirus news is making it worse. Obviously we all hope for the best from a human standpoint. I mean, nobody wants to see this thing spread any more than it already has, but I think it's probably inevitable that it does in an interconnected world economy that we have. So we're going to be dealing with this issue for some time, and I think, again, that's why you're seeing interest rates, get some extra sort of downside momentum, but and upside momentum in things like gold that people buy when they're looking for safety. But those trends were already in place. I mean, gold's been essentially in a bull market move since the summer of 2018. Interest rates have been falling and bond prices have been rising since around the same time. And those defensive sectors we talked about before, things like utilities and so on, have been outperforming for 2 years. So that tells you that something more than just the virus news is going on here.
Now, the administration in Washington basically says the economy is going to be growing at 3% plus this year. We've got the trade deal with China, so that trade uncertainty is out of the way. We've got the USMCA, so we've got Mexico and Canada. We know what's happening with Brexit now. The three main things that were kind of hanging over the market in 2019 have been resolved, so it's off to the races. What's wrong with that view of the world?
Sure. I think that view tends to ignore some of the cyclical type things that are going on, particularly in the credit markets behind the scenes. I'm a big credit cycle guy, and I think maybe it comes from following the mortgage industry and sort of what happened in the mid-2000s and how we had this enormous boom driven by easy mortgage credit. And then when that, the tap got turned off, as you say, for mortgage credit, it impacted the broader economy. We've seen something similar this time around where we've seen extremely easy conditions in the corporate credit market, a lot of high-risk lending and borrowing going on, companies leveraging up their balance sheets, taking on a lot of risky debt and in many cases, spending that money wantonly and non-productive things such as stock buybacks and so on. So you have that issue that's been out there for a while. If you look at some data from the Fed that looks at credit demand, is there more or less demand for business loans? Is there more or less demand for credit cards and auto loans and so on? And at the same time, are the banks being more generous or looser with credit, or are they being more stingy and tighter? And what's interesting is that for about a year now, we've seen credit demand gradually weakening, and we've seen banks gradually tighten standards. That's what you tend to see at the end of a credit cycle. Banks start to worry, hey, I'm losing some money on these loans that I wasn't losing money on a couple years ago. Or, gee, we've lent as much as we can to all the good credit borrowers, and all that's left is people who probably shouldn't be getting loans in the first place. So you see banks tend to turn off the taps a little bit. And that's what's been going on. And again, it's in the Fed's own data. So when I see that kind of stuff going on, yes, these big headline news, it's great. We get this phase one trade deal, or we have, a détente with China on one level. But at the same time, other things are going on in the economy that don't get talked about as much, but I think are equally as important. And that's what I think the other markets are picking up on. I mean, again, interest rates are telling you something. Gold market is telling you something. Even that breakdown in the stock market. Why are things like utilities and REITs doing well so much better than growth sectors? When do you typically see that in the cycle? You tend to see it in the year or two leading up to a recession. I mean, if you go back to the dot-com year of 2000, we all think, oh, geez, that was a horrible year for the market. And it was if you own tech. You lost 40-some-odd% of your money in just the main tech ETF in the year 2000. But do you know that same year the REIT ETF and the utilities ETF were up about 21%? It was a real split. And it's interesting that you saw those kinds of patterns emerge very late in the cycle back then, and I don't think it's any accident that the same pattern is emerging now.
So let's talk about utilities first. So we have falling oil and gas prices as well as part of the whole coronavirus situation, so that should be good for them. What is the best way, do you think, for people to play utilities? Is it individual names, or do you have some ETFs or mutual funds? How would you play people who at current prices in the utility sector?
Sure. I mean, you pointed out earlier, and it's true that they've already had a pretty big move. So it's likely you're going to see corrections, pullbacks, whatever you want to call it, at some point, and probably not in the not-too-distant future. That being said, just like in any bull market, I think those are corrections or pullbacks you want to take advantage of and buy. You can just target an ETF, such as the Utility Select Sector ETF, ticker symbol XLU. That's the ETF that tracks the entire utility sector. And the two-year returns on this thing are about 52%, so that's pretty impressive. I like to drill down and look at individual names that tend to rate highly in our Weiss Rating system. I think that you do tend to find that higher-rated stocks over time will outperform lower-rated ones. So one that I've been very bullish on for quite some time, I've mentioned it in presentations, I've mentioned it, it's in the newsletter portfolio, is Next Era Energy, ticker symbol NEE. That's the main utility here in Florida. They're doing a lot in the renewable space, a lot of solar, wind power generation, and so on. And that company has been a phenomenal performer. It does great on up days for the market. It holds its own on down days. And it's really been a rock-solid performer. So NEE is a company in that sector that I like quite a bit.
So that's an electric utility. How about gas utilities?
When it comes to some of the transportation, gas transport, oil and gas transport companies, I mean, your listeners know, I'm sure, things like master limited partnerships, some of these companies that don't, they're not producers. So it doesn't really theoretically matter what the price of oil is, the price of natural gas is. It still has to get from point A to point B and be stored and processed along the way. So there's a company called Enbridge, ticker symbol ENB, that I like. That's a company that's in that space and is a recent portfolio addition. It's pulling back a little bit with the market, but I think that's a company that's involved in a lot of the again, sort of moving energy from point A to point B that I think is a pretty decent risk reward. And the yield on that on Enbridge is around 6%, so you've got a nice dividend pickup there as well.
So these are moving both on the energy front, but also as bond proxies, right? As interest rates on Treasuries fall, utilities go up on that, and you think rates are going to fall further, so that would mean even higher prices for utilities going forward.
Yes, absolutely. I mean, your biggest risk in this sector now or almost at any point in the cycle is that something unexpected is going to drive interest rates higher. The economy is going to unexpectedly accelerate, or we're going to get an outbreak of inflation, or fill in the blank of what might cause that, foreign bond selling and so on. But if you look at this environment from the big picture, sort of a multi-year standpoint, I think we're kind of caught in this again, to use the acronym, LERP, ZERP, NERP world, low, zero, or negative interest rate policy. It's not just a U.S. phenomenon. We know that overseas, in Japan, in Europe, and in other countries, central banks either couldn't raise rates at all during this entire economic cycle, or they've actually been keeping them suppressed in zero or negative territory for years and years. When that happens, that tends to drag down interest rates globally, and it certainly has spilled over to the U.S. Even the Fed itself is out there. They're in the process of studying policy right now and trying to come up with other ways to hit a 2% inflation target because they've been missing it here for several years now. I think a lot of it stems from demographics. An aging population means more saving, less spending, less dynamic nature to the economy, and so on. Some of it depends on other structural factors. And in that situation, you layer on top of that the potential for a downturn, slowdown, recession, whatever you want to call it, over the next 12 to 18 months. And you've got a reason to expect the Fed to cut interest rates further, and long-term interest rates are already leading the way. I mean, we have a 10-year Treasury yield that's essentially flirting with its all-time low, all-time U.S. history low.
Yes, indeed. Very good. Okay, we're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Mike Larson, Senior Analyst at Weiss Ratings, editor of the Safe Money Report. You can see more about it at his website, weissratings.com. We'll be back after this. Are you sick and tired of earning only 0.1% on your bank account savings? Well, it's time to earn much more interest by opening a Wealthfront cash account. Right now, Wealthfront is paying 1.78% annual percentage rate on your cash. That's about 19 times more than the average rate of 0.09, which banks are paying these days. With that much of a higher rate, you can accumulate as much in 4 months that it would take you 50 years to build up at a local bank. Every year you make New Year's resolutions like to eat healthier, work out at the gym, or earn more money. Well, now you can keep that last resolution pretty easily with a Wealthfront cash account. There are no fees to set up your account, and your money is insured up to $1 million by the FDIC through their partner banks. It only takes $1 to open an account, which you can do quickly online or over the phone. Wealthfront currently has about $22 billion in client assets on deposit. Clients have earned over $70 million in interest on their cash accounts. In addition to being a great place to earn much more interest on your money, Wealthfront's an ideal place to manage your money. You can save, plan, invest, and get solid financial advice all in one place. In fact, my son, who works in the high-tech field, has moved all of his assets from a traditional brokerage firm into Wealthfront and put it into a managed basket of index funds that have performed extremely well. Right now, you can sign up for a Wealthfront cash account in less than 5 minutes by visiting wealthfront.com/money. Go to wealthfront.com/money and start earning 19 times more interest than you can get from a bank. That's wealthfront.com/money. Wealthfront is not a bank. Cash account is offered by Wealthfront Brokerage LLC, member FINRA SIPC. Wealthfront conveys funds to partner banks who accept and maintain deposits, provide the interest rate, and provide the insurance. The APY is subject to change.
Stocks, bonds, investment opportunities, financial news, and talk. We can help. Call us now toll free, 866-472-5790. 866-472-5790. Voice America Business Network.
Do you or someone you love have a life insurance policy that's no longer needed or not affordable? Did you know that you can sell your policy for cash? Your reason for buying life insurance has probably changed. Thousands of Americans turn to life insurance settlements to help sell their policies. They act as your representative, getting the highest market offer for you. You've got nothing to lose by simply inquiring. If you're over 64 with $100,000 or more of life insurance, you may already qualify. Call 877-485-6681 to get your free non-binding appraisal or visit fundinglife.com. Life Insurance Settlements. Discover the true value of your life insurance. 877-485-6681. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners. Tune in to the Voice America Variety channel on the Voice America Talk Radio Network. Voice America Variety broadcasts a diverse array of topics, reaching a global community. Our experts come from all walks of life, and the topics they discuss are everything from current events, arts and entertainment, leadership, parenting, relationships, self-improvement, career advice, and a variety of other topics. Check us out today. You're sure to find something of interest. Voice America Variety. Talk on today's hot topics.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Mike Larson, Senior Analyst at Weiss Ratings, editor of the Safe Money Report and Under the Radar Stocks. You can find out more at his website, weissratings.com. Welcome back to the show, Mike.
Yeah, glad to be here.
So we were talking about negative interest rates, how U.S. interest rates have been falling, but in Europe and Japan, they've been literally under zero for quite a while now, but whatever, $16 trillion worth of bonds trading negative. Do you think America will ever get to negative interest rates? And if that were to happen, what would that be telling you about the economy?
It's amazing to see sort of where we are now, and especially when you take a longer-term perspective and you look at where interest rates were in the late 70s or early 1980s, and people always say, I remember when I paid 16% or whatever to get a mortgage, and now if you told somebody that in the millennial generation or Generation Z now that actually happened once, I think they'd stare at you like you were crazy. But we all know that at one point in time, interest rates were much, much higher, and now we're talking about a 30-year U.S. Treasury that's around 1.85%, an all-time low. 10-year U.S. Treasuries right around 1.3, 1.4 in that ballpark. I mean, these are astonishing numbers. But again, when you look at the rate market and the cost of money from a global perspective, we're all linked in one way or another just because of economic links and investment links and so on. So the fact that in Europe, throughout this entire economic cycle, the ECB never got rates off the floor and has kept interest rates, their version of our Fed has kept interest rates pegged just below zero for many, many years. And you look at the Bank of Japan, which has done the same for many, many years, that ultimately acts as sort of a downward influence on U.S. rates. Even though our economic circumstances are somewhat different and our demographics are somewhat different, we are still connected on some level, and that's why our interest rates have been dragged down. And think of it, that's in an economy in the case of the U.S. where unemployment's been at multi-decade lows. Growth certainly hasn't been fantastic. We're not getting 3, 4, 5% GDP growth, but we have been generally getting solid 2%-ish growth. And in that environment, we still haven't been able to see interest rates really get off the mat. So I think it's only logical to assume if that's all we could accomplish or all we could do or all we would see in interest rates during an economic expansion, what happens if I'm right and a slowdown and potential recession is coming? In that scenario, what do you think is going to happen to interest rates? The Fed's going to be forced to cut even further. I mean, they've already done their big pivot from raising rates to cutting rates. They've lowered rates 3 times. If they get if they see economic data deteriorate enough that they have to cut a couple more times this year, which is sort of my forecast and expectation, then we're not going to be very far off of 0% again. So I think that in this environment, it's very tough. If it was hard to see interest rates rise notably during the expansion and during a very strong bull market for stocks and other assets and so on, it's hard to see in a recessionary or weakening economy interest rates doing anything but fall. So that's what I've been positioned for, and it's worked out very well. I mean, in the Safe Money Report, we have things like we have a couple of ETFs. One is essentially a bet on falling 7 to 10-year interest rates, and then another is a bet on falling very long-term rates, and those have paid off very well. It's funny when you talk about, you mentioned how stocks have been in a bull market, and that certainly has been generally true. But if you go back 2 years and you compare the return of the SPY, the S&P 500 ETF, against the EDV, which is Vanguard's ultra long-term Treasury ETF, it's funny, Treasuries are outperforming the stock market. You've made about 45% total return on that Treasury ETF versus about a total return of 28% in 2 years on the S&P 500. It's a remarkable statistic, and it shows you that the bull market in bonds in some way has been even more powerful than the bull market in stocks since 2018.
So in this environment with low and falling inflation, sometimes negative inflation, you'd think that would be bad for gold. You think of gold doing well during inflationary times, yet you're very bullish on gold. What are your reasons why you think gold is going to go higher? It's already had a big move here recently, but why do you think it could go even higher?
Sure. We have a very unique situation, not just now, but really for the last 18 months or so, where you've seen in tandem Treasuries rising in price, gold rising in price, and the U.S. dollar rising in value against other currencies. That really sort of flies in the face of the historical pattern. Usually, historically, gold would do well when the dollar was falling in value, but the opposite would be true. If the dollar was rising, gold would be falling, and so on. But why are all these asset classes rising at the same time? And I think it goes back to the end of the cycle, the need for safety, the need for protection in a rising volatility environment. I think people are buying gold as, I coined a term, chaos insurance a while back. I've used it in presentations. Essentially, when all else fails, gold is something in your portfolio that hopefully offsets some of the problems you're having elsewhere. So that's one thing. Another thing is, we discussed earlier how low interest rates are. In a negative interest rate environment, 0% yielding gold is actually a better yield than, say, minus 50 basis points on a foreign treasury bond, for example. So people are buying gold because it, at yielding nothing, is actually, quote-unquote, higher yielding than some of these negative interest rate products. So you've got that going for you. I also think, when you look at, again, what tends to do well at different points in the cycle, gold tends to, as you head into choppier, more volatile markets, gold is one of those things that tends to outperform. And, when I see what's supposed to happen actually happening, that reinforces my bullishness. So you look at all those factors, and then you throw in one last thing, which is central bank buying. For many, many years in the 90s, for example, you had central banks that were actively selling gold, and it just helped act as like a depressing factor on the price of the metal. But now, in the last couple of years, we've seen more central banks, foreign central banks, particularly those in countries with which we're, arguing or fighting or whatever term you want to use. Think of Russia, for example, or China and so on, and some other emerging markets. Central banks are buying and accumulating gold. The Russian central bank actually sold tens of billions of dollars worth of treasuries from reserves and reallocated that money into gold. So when you see that kind of real money buying on top of all these other things, it results in the bull market that we've clearly seen for the metal itself and many of the mining stocks.
Why are the central banks buying so much gold?
I think they're trying to de-dollarize. It's just a fancy term of basically make their economies less sensitive to or less tied to what the U.S. economy and the U.S. dollar is doing. Some of that is just, again, in the case of Russia, obviously our nations, have had a lot of geopolitical back and forth in the last few years. Certainly with China, the situation is the same. And then you have some central banks, again, things that have gone through currency-related turmoil, like Turkey, for example, and they're trying to find some stability in the metal as a historical, store of value. So that's what's going on there, I think. And then when it comes to the stocks, the gold and silver mining companies, for example, it's important to remember that they did nothing for 6 or 7 years almost, while the rest of the market was in a raging bull trend. So if you're looking for a sector that's actually cheap and that the bull market forgot for quite some time and left behind even, if you will, it's really in the mining stocks. They've already been through the wilderness. They've had a lot of the weaker companies have gone out of business or shut down or basically folded operations. So a lot of that sort of leanness, all those bear market or sideways market things that happen, they've already gone through the ringer. And so I think that's one of the sectors that is arguably still undervalued after many years of doing nothing or declining in value.
So would you play the mining stocks through an ETF like a GDX or GDXJ, or there's some individual mining stocks you would like?
Sure. I think, I take the same approach there, and I'll tell people when I talk about the sector that it's great. The ETFs are a fine starting point. There's nothing wrong with GDX as a way to access the gold miners. It's going to have most of the major names and so on. But just like in other sectors, I think especially if you have a larger portfolio, and once you get sort of your allocation in ETFs, maybe it's worth doing the extra research and time to find individual miners. For example, within the mining sector, I really like the royalty streaming companies. These are companies like a Wheaton Precious Metals, ticker symbol WPM, that doesn't just operate one mine here, and if something goes wrong in terms of labor issues or the reserve turns out to not be as good as they thought and so on, that can be devastating to the company's share price. Wheaton actually spreads its bets. It finances the operation of mines that other people run and then collects a royalty or stream of income based on how much gold and silver those mines produce. So it's almost like it's almost like owning a mutual fund or ETF, but it's a company that's gone out there, done the work, doesn't have the operational risk of running mines, but does get to share a percentage of the profits in the gold and silver that those mines produce. So Wheaton is probably my top name in the space, and in the model portfolio, it's up about 50% for us.
I guess Franco-Nevada is another one that does royalties as well. Is that right?
Correct, yes. That's another one of the big royalty names out there. And I think within the mining industry, those are probably some of the best bets, not just for diversification, but in a low-yielding sector, a sector where dividend payouts are less generous than other ones. These guys actually do have higher yields than many of their fellow mining companies, so it gives you a little bit of a yield kicker as well.
Very good. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Mike Larson, Senior Analyst at Weiss Ratings, editor of the Safe Money Report. You can find out more at his website, weissratings.com. We'll be back after this. You may not be the greatest at getting places early, especially when traveling and getting to the airport early enough to avoid that I might miss my flight anxiety. That's why I'm excited about Clear. Using Clear reduces your stress big time because you bypass those long security check-in lines. So you never have to run to your gate again. Clear helps you zip through the airport security with a tap of your finger so you can get to your gate faster and relax. Clear replaces the need for physical ID cards because the system recognizes your eyes and fingerprints to get you through security quickly. With Clear, you are the best ID. Enrolling is quick and easy. Get started online, then finish enrolling at the airport with the help of a friendly Clear ambassador. No need to make an appointment, and it takes just about 5 minutes. Then you can immediately use Clear. Clear also helps you get through security faster at stadiums and other locations around the country. Clear members can add up to 3 family members for the discounted rate of only $50 a year. Kids under 18 are free when tagging along with a Clear member. I remember vividly when I was taking a flight out of Las Vegas, and the line of security would have taken at least an hour to get through, but I breezed right to the gate using Clear. Another time when I was coming home from Orlando, I zoomed past hundreds of screaming kids with all their Disney costumes on to get to my flight in plenty of time. Clear is absolutely the best way to get through airport security. It works great with TSA PreCheck, too. Right now, listeners to the Money Answer Show can get their first 2 months of Clear for free. Go to clearme.com/moneyanswers and use code moneyanswers. That's clearme.com/moneyanswers and use code moneyanswers for your free 2 months of Clear.
From the boardroom to you, Voice America Business Network.
Are you a homeowner tired of making monthly mortgage payments with little progress towards paying down your principal? Does paying off your home in 5 to 7 years without making larger or more frequent payments sound appealing? Paying off your home in full in 5 to 7 years is really possible thanks to Truth and Equity's Mortgage Equity Optimization System, a money management approach that puts your money to work for you 24/7. If you own a home with some equity, have a decent credit score, and verifiable income, you owe it to yourself to learn more about Truth in Equity's program. There's no need to replace your mortgage or refinance in many cases. The system works for new home purchases as well as current mortgages. Your home is your largest investment. Own it outright in 5 to 7 years. Call Truth in Equity 888-262-5540 or visit truthinequity.com 888-262-5540. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
You've been listening to The Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to The Money Answer Show. This is Jordan Goodman, your host. My guest this hour, Mike Larson, is Senior Analyst at Weiss Ratings and editor of the Safe Money Report and the Under the Radar Stocks newsletter. Welcome back to the show, Mike.
It's a great time to be on, that's for sure, with everything going on in this market.
Tell us about the other newsletter you do, Under the Radar Stocks. What is that about, and what are some of your favorites there these days?
Sure. In that product, we're looking, we're willing to take more risk in search of higher returns. We are generally screening for companies that are only followed by 0 or 1 traditional Wall Street analyst, but because our system is quantitatively based and just, takes the data, crunches the numbers, and so on, we can essentially run our model against every stock that trades in the U.S. markets. So what that particular product is looking to do, again, is identify these gems, these companies that are less widely known. It's certainly not going to be recommending things like Apple. It's going to be smaller companies that their greatest growth days may be ahead of them. Even in that service, for example, though, I've specifically been focusing more on things like gold mine and silver miners because I think that's where a lot of the opportunity is. There's a small company called Gold Resource Corp, for example, ticker symbol GORO, that's been in there for a while, and that company's been performing a lot better recently. That, again, sort of tied to the mining sector, but also being a smaller cap, smaller type name in the sector that's got a lot of growth potential ahead of it. So that's what we're trying to do with that in that particular name. And even in there, you can find, for example, some smaller utilities like a Middlesex water company, MSEX. That's actually a name that is benefiting from the trend, the overall sort of tide lifts all boats type trend, but also is doing some smart things on its own. So those kinds of companies, as long as you're in sync with the broader trends of what's doing well and kind of trying to avoid what's underperforming, you can do pretty well with those names too. Although I will say, as we've been discussing, this has been a market that's been less forgiving and less understanding of small cap companies for really the last 18 months or so versus some of the mega cap names that you find in the S&P 500. So, and I think that tends to be what you see in a late cycle environment as well. The smaller companies have bigger issues with credit risk, they have less diversification, and so on. So if you see markets, people being uncertain about whether the economy is going to continue to grow and whether recession is a real issue, then your smaller cap companies in general are going to underperform, and that's been what we've seen.
So what areas of the market do you think are dangerous? I've seen, for example, that you are worried about junk bonds. There's been a lot of money going into corporate debt. Are you concerned about the junk bond market and going into junk bond or ETFs like JNK?
Yeah, very much so. I think that if you look at the credit markets overall, the economy overall, and you try and find where have we seen the worst excesses? Where have we seen the riskiest behavior? Where have we seen, whether it's from a lending or borrowing standpoint or an investment standpoint, where have people shown the least caution, and where are assets really valuations out of line with the underlying fundamentals? In the last cycle, it's no mystery where that was, right? It was mortgages and housing and so on. I mean, everybody was flipping Vegas condos, and they were giving mortgages to people who didn't have jobs and didn't have assets and so on, and lied about their income and so on. In this case, you're seeing a lot of excess risk being taken on in the corporate credit market. Companies having money thrown at them left and right. Companies paying very low rates to access money, frittering that money they raise away on sort of non-productive, non-revenue and earnings boosting behavior. And you see a lot of, just like back then, I mean, everybody was piling into risky mortgage bonds. You see a lot of investors, both institutional and individual, that are just chasing yield. They're piling into high-risk, high-yield bonds because the yield is better, but or the yield is higher, but can those companies really, afford to pay their debts and not default in larger numbers if the economy does turn down. And I think we got a taste of what's to come back in when you had in sort of the 2015, 2016 timeframe. Look at what happened to the energy sector. A lot of those shale companies were borrowing enormous amounts of money to boost production. Then the price of oil crashed, and a lot of the stocks involved crashed, and a lot of the bonds involved crashed. That was energy specific. In this case, you're seeing the same kind of behavior in a lot more industry groups. It's not just an energy thing. You're seeing risk pile up in other sectors of the economy that are in other parts of the junk bond market. So I think really for a number of quarters now, the last few quarters, I've been saying if you had to boil it down the investment strategy, it's sell junk and high yield and buy treasuries instead. At this phase in the cycle where you're worried about defaults going up, companies having less money coming in the door to pay their debts and so on, especially when leverage is very high, or in some cases at all-time highs, depending how you measure it on the corporate side. That's not an environment where buying a high-yield bond or one of these funds that invests in higher-risk bank loans and so on really pays off for you. Your yield is too lousy for the risk you're taking on. So if there's one danger area, it's that, and it definitely, if you need fixed income exposure, you want bonds in this environment, even at lower yields. I think you want treasuries rather than high yield but debt because of the lack of default risk.
One area particularly people talk about is leveraged loans. Is that something that worries you as well?
Oh, absolutely, absolutely. Again, if you think high yield in general or higher risk bonds in general are dangerous, the explosion in leveraged loans outstanding, the explosion in borrowing, the restrictions on what companies can do with the money that are called covenants, all of these risk factors. If you can, I've in my presentations, I tried to think of a way to sort of put it in layman's terms what this all means, and I actually came up with the Yertle the turtle example. If you ever remember that book when you were a kid from Dr. Seuss, basically it was the turtles just kept stacking themselves higher and higher on top of each other's backs because Yertle the king wanted a better view in his pond, and then it all came crashing down in the end. You're layering a lot of risks on top of each other in the corporate market, and that's a real issue. It's just to look back at the mortgage sector, it's like when you didn't just give a bunch of subprime loans, but you gave them to people who lied about their income, who didn't have money in the bank, who had low credit scores, who were buying investment properties with the money. It was risk on risk on risk, and that's what causes problems. So that's why I just think as an individual investor, you want to limit your exposure to that kind of stuff and just stick with treasuries and higher quality companies that don't have that leverage risk out there.
And you're saying this is happening not only domestically in the U.S., but around the world as well, where there's a lot of corporate debt in Europe and Asia.
Oh, yes, for sure. I mean, again, it's been actively encouraged. I mean, let's understand it's been actively encouraged by central bank policy. When you have central banks that are in Europe, for example, that are buying enormous amounts of corporate debt, it drives down yields overall, not just on government bonds, but on bonds issued by corporations that theoretically have other risks that governments don't. I mean, governments generally can't go, well, with the exception of some of them, generally don't go bankrupt. But companies, that happens all the time. So I think there's a real issue where it's happening overseas, and that feeds back into our markets as well. So again, it's just a question of, are you getting enough yield for the added risk you're taking on? And at these levels and at this point in the economic cycle, I just think you aren't. So that's the kind of stuff you want to avoid as an investor.
So let's add political risk to the mix here as well. Say for a moment that Bernie Sanders became the new president and had a Congress that could do everything he wanted. What would be the impact on the economy of massive tax increases, massive social spending, everything he's talking about?
Yeah, I try and look at politics through a nonpartisan lens and just say, look, for the sake of my listeners, my readers, it's all about what the impact is going to be on their investments. There's other things that factor in real life, of course, but that's what I try and limit my perspective to. And when you look at what happened when Trump came in office, love him or hate him, things like infrastructure spending, talk of that, things like corporate tax cuts that boost profits, the things he did were very stock market and for a while economically friendly. It was obviously part of the reason why after you got over the initial shock on election night, the markets took off and kept on running. But I think we're starting to run out of some of that steam now. And then if you look at, for example, what might happen under a Sanders administration, if he truly gets what he wants and is able to do the types of things he's talking about, again, whether you think the healthcare and education and other programs are good for society as a whole, from an economics and market standpoint, they're going to be negative because it's going to involve more taxation. It's going to involve clawing back some of these corporate-friendly tax moves and so on that have been put under place in the Trump administration. So I think, yes, it would be probably a negative shock to the market if Sanders is truly elected and moves forward with the kinds of things he's been talking about.
Very good. Well, we've covered a lot of ground. My guest this hour has been Mike Larson, Senior Analyst at Weiss Ratings. You can find out more at his website, weissratings.com, for his 2 newsletters, Safe Money Report and Under the Radar Stocks. Thanks so much for giving us a lot of great insight, Mike.
Great. Thanks for having me.
Thanks again. We'll be back next week with another edition of The Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.